very brief word on investment process. We've been going through this graph with our shareholders. We're a long-term investor, so for us that means we're holding stocks typically 10 to 20 years, and in that, which is pretty unusual in the markets these days. So in that environment, we want to have quality companies in the portfolio that are going to add growing dividends over that sort of period, because that's basically how you're going to communicate that long-term approach to your shareholders through growing dividends. So we're interested in quality companies, good balance sheets, good management, strategic assets, competitive advantage, all those sorts of things, but with the prospect of growing the dividend over time, which is pretty important to us. The value part of the equation is we're pretty contrarian. We don't like to buy things that are overpriced or that are sort of a bit of a market theme, and we tend to look for buying things where we can that are out of favour with the market. I don't think that goes for Healthscope though. We've underperformed a bit over the 1 and 3 year numbers. These are the performance numbers, including the benefit of franking credits, which we feel is important because we have a fully franked dividend, whereas the market is only about 80% franked. And so the question we've been going through with shareholders, why have we underperformed over those 1 and 3 numbers? And part of the reason is shown in this graph. This is a 10-year graph, and it's showing AFIC, which is the sort of aqua line at the top at the end, compared to 3 other items or assets. One is the property trust in purple, which has done pretty well over the last few years. The grey one is Aristocrat, which is a proxy for gambling, and the gold one is Newcrest, proxy for gold. So what we're trying to show to investors in this is that if you look at the short-term numbers, 3 years, you'll see that all 3 of them, Gold, Property Trust and Aristocrat, have had massive rises, whereas in the case of AFIC, we haven't risen nearly to the same extent. But if you go back over 10 years, we've actually outperformed those three counters. And the purpose of this graph is really, we are not an investor in gold stocks because we don't think we can work out where the gold price is ever going to be. It's sort of driven by factors that are beyond us. And in any event, most of the companies are speculative. Very few of them have fully franked dividends that we can pass on to our shareholders. In the case of gambling, we've never been a particularly enthusiastic investor in the gambling sector. In fact, we don't invest at all in companies that are purely gambling. We've got some residual exposure through Woolworths and Coles, obviously. But so that's a sector we haven't been in. Occasionally we get asked why not. And essentially we've had this view that we didn't want to be in an industry that was created harm for some people, not necessarily all. And investors can do it themselves. So we're not going to be an investor in gold or in gambling. But the third one, Property Trust, is probably a bit aberrant. And our view on the property sector has been that we wanted to be in assets that were unique. So things like shopping centres that you can't easily replicate. We're not particularly interested in industrial parks or office buildings, which are fairly easy to reproduce. So we haven't been an investor in that sector. And over the long term, they haven't performed as well as the industrial shares, but they have done very well in this very low interest rate environment. And that's caught us out a bit. We have been asked why we didn't invest in 2009 when they all collapsed and had equity raisings. That's a very good question. We'll have to go back and think about that for our process. But one of the things we have been doing in the last few years is changing the composition of the portfolio more towards mids and small caps, and I'll get Mark to talk about that.
Okay, thanks, Ross. So what we thought we'd do in this presentation is really look back over the last 3 years in terms of what have we been buying in the portfolio, because normally we have a 1 year view of what we've been doing, but we thought it was more interesting, given the way we invest, is to look back over the last 3 years in terms of what we've been buying. So, and a lot of the buying you can see in these stocks, we did a lot of this perhaps more 18 months to 3 years ago rather than the last 18 months. So a lot of these stocks now have run really hard, and we'd like to buy more of these, but they're just too expensive, and hence some of the issues you're seeing in the likes of Healthscope, where they downgrade their earnings. If you're on a high multiple, then the stock price can fall a long way. But then at this sort of fall, it starts to come back onto our radar in terms of, we were saying, when do we start to look to buy more? But all these stocks, we wanted to get more into the portfolio. We thought they had some really good long-term growth characteristics. We did trim a little bit some of our top leading stocks at the time. We took a little bit off our banks because we think banks, it's just going to be harder to get strong growth for the next decade. We've talked about some of the issues around whether it be Telstra as well, and we trimmed a little bit of Woolworths a few years ago. Businesses where we think, as I said, long-term growth is not going to be the same as what we've seen over the last 2 decades. So putting some of these stocks into the portfolio has worked well for us. So we just went back and looked at what we'd done 3 years ago. We only had about $170 million in those stocks that I showed you. We invested about $700 million into those companies, and those companies now worth about $1 billion. So it's been a good return for us. Probably the thing is we should have done a bit more, but it's added some good performance to the portfolio. Just some of the things we're thinking about the market at the moment. When we look through it, mid and small caps, we have been talking about this, but once again, just trying to highlight, we did quite a bit of buying some time ago. They look very expensive to us now, so we're quite cautious on that part of the sector. Interest rate sensitive parts of the market as well. Again, as a long-term investor, looking at that interest rate cycle, this to us looks as good as it can get. So when you think about property trust sectors where we are a long way underweight, infrastructure, regulated utilities, even those gambling stocks. When we look forward over the next 10 years, we think they're going to be very difficult to outperform in those sectors as interest rates start to move. And I think we are of view of rates will start to rise, not quickly, but certainly, again, looking over 10 years, the rates will probably be higher than where they are now. Some of the large cap holdings, as I said, we took a bit off the top. They're probably looking reasonably priced now, but we're not expecting strong growth. But certainly seeing some better value in the likes of, Telstra's fallen quite a bit now. Again, we think it's going to be a more competitive market going forward, but it has fallen. Some of the banks, the yields still look okay to us. And so what we're doing now in terms of what we're doing, we're really sitting on our portfolio at the moment, and we're looking for sectors as they go out of favour. And Ross mentioned that we're contrarian, but we are looking for quality. So if we see hiccups in sectors, that's where we're looking to add new stocks to the portfolio.
The final comment before we open for questions, we do run 4 different listed investment companies. Djerriwarrh is a similar portfolio to AFIC, but it's only about 800 million, whereas AFIC's 6.5 billion. Mirrabooka is our mid and small caps. So that's in stocks outside the top 50, and that's had a spectacular run in recent years. Hasn't done so well in the last 1 year at only 19.5%, but that's because of the resource sector having an enormous bounce. And AMCIL is about 250 million, and that's a mixture of big and small stocks which we think are the best picks. So that we sort of cover the whole universe, but it's an interesting combination of counters. Just comment, AFIC's trading at about a 2% premium to them at the moment. Djerriwarrh has come down from 40 to about 15. That's all interest rate related. Mirrabooka is about 20% premium, and AMCIL is about par. So